compensation plans, or what some people refer to as management carve-out plans. We've been seeing a lot of these in the past year with the economy down, equity values depressed, and the IPO market being relatively non-existent, although it's starting to come back. Lots of companies are considering an acquisition as their real exit event, and management is concerned about how they're going to be compensated, where their equity in some cases doesn't have a lot or any value. So a management carve-out plan is basically a cash-based bonus program where executives will be paid a cash bonus based on the transaction value. Usually there are select key members of management that are selected to participate in the program, and the primary goal is to provide them with adequate incentives to stay with the company through a successful acquisition and ideally maximize the value of the company at sale. Tom, what are you seeing in terms of how companies are determining how to create the size of the pool and the distribution of that pool?
Well, so size of pool is closely related to the number of participants. And, generally, unlike with the option program where it might go to everybody, these programs are usually very limited to key contributors. So very few people at the top. How much of that they get, there is no well-defined formula, but it would start to approximate what would be felt like a fair amount that they should have received on their equity. So you'd say normally you'd see these pools within a 5 to 15% range, though a lot of variability. There can be some other bells and whistles that there's a floor below a certain amount, nothing's paid out. There can be a ratchet above a certain amount, the percent increases. But that's a general range, though there is a lot of unique negotiation going on these programs.
One comment I'd make on it, actually it's a question for Tom. I mean, I've seen these a lot, but it always seems really difficult to put a carve-out program down in writing until a transaction is fairly imminent, because it's all hypothetical and people don't know what's really going to happen. And when a transaction starts moving down the road to reality, that's when people need to get real about putting it in writing, and it's hard to get everybody to move off the dime. Is that
Well, that is certainly one of the big issues. Okay. The executive team will want it to be hardwired at the time they talk about it at the beginning of the process, and the board usually is less comfortable with that.
I just as a CEO on this, that's the part of the movie where your investors say, "Well, we'll take care of it." And I'm thinking, well, we've all been aligned all the way through the whole process, presumably, and then you get to that point, and then it's, "We'll take care of you." I don't know. It seems like it's something that's a little bit more transparent on both sides makes sense, and even if you have to change it later on as the circumstances change, at least you've got a starting point. So I think because you're at that end game, the chances of being on the same page are a lot less. And so, getting something that's documented and agreed on both sides, everybody has their eyes open going in, seems to me to be a better way to go. And then if you have to amend it. But going in with a pat on the back and we'll take care of you at that point seems inadequate.
I guess, we'll take care of him. No, I think you wouldn't be at the point of negotiating a management carve-out if it wasn't the economics of the capital that went into the company versus the value of the company weren't out of whack, right? Because otherwise this is irrelevant. Equity is equity, everybody. So there's a whole set of expectations around this that are, and emotions potentially around it that are difficult, because you can't, it's an uncomfortable discussion when you're having a carve-out, because it's not at the best outcome, it's somewhere in between, but there is some outcome to be had. I think the right approach is, and we've dealing with this on a case-by-case basis in my limited career so far, is you do want to have some understanding in place and have some level of the sense of the range of the percentages. I think getting into the details of how that's split up or actual numbers is probably really hard early on, because you don't have that in place. But so I would go to the point of saying my approach would be, and my recommendation would be, try not to get everybody down to a contract on a piece of paper, but maybe have some range of what the expected numbers would be in that situation, so you can see whether it's worth it. And it's got to be worth it, because otherwise the management team is not going to stick around to make the deal happen. So you have to make that happen. I think getting into again, my own personal perspective would be if the management team wants to get everything down on a contract that is relatively unclear, when they should be keeping their eye on the ball of bringing the transaction home or growing the business, it's an incentive. It's a bad signal to me. I mean, I think it takes a lot of time to get contracts in place. So I think you should be able to get some range, but not have everything buttoned down. That's the way I would approach it. I don't know if that makes sense to you, Bill. Is that sound still too much like we'll take care of you, or does it sound like there's a range or a number that?
I mean, I think if you have a pretty extensive discussion around it and there's an understanding, then if you feel like you can trust the people you've been working with for several years, then that's not an unreasonable approach. But that's better. That's a lot more detail than. Yeah. We'll talk to you later about it. Yeah, the other thing is, I do think that sort of if you're a CEO and you're thinking about who you're having that conversation with, the guys on the other side of the table should surely be aware of the fact that you have a huge impact on the price. And if you're trying to sell it for more than just asset value or something like that, the way that you position the value of your company and you're taking it to whoever's going to be the buyer, the more passionate you are, the more convincing you are, the better price you're going to get for that business. And if you've got a deflated, demotivated, sort of whatever kind of a person out there pitching that story, your investors are going to know that, and certainly they don't want to go down that path, right? Yeah, so there's incentive on both sides to make sure that everybody again is aligned.
So in your experience, how many months before, let's say, a deal do you take out at the board discretion, out of the language of the carve-outs?
Well, it's interesting. I mean, in my career, I guess, have been involved in sort of two exit processes. And I think, if you go back in time, one of the other questions is really, as an executive, did you have a management contract in place that already talked about change of control at some level, not, in terms of just your options vesting and compensation and, what's your new job and all that kind of stuff. And I don't know how prevalent management contracts are, but, that's sort of been my experience that you have something written down already in advance that takes care of some of that. So now we're talking about the last aspect of that, which is sort of the exit piece of that. Those processes take a few quarters. I can imagine you're starting that conversation 6 to 9 months in advance, and it's a conversation. And as you get closer to, let's say it's an auction process or something like that, that's when there's a real process in place, then you should surely have a pretty good understanding of how it's going to work out. If it's still we really want to stay independent, and this is sort of our backup plan, it's kind of hard to get to Ammar's point. You're sending mixed messages if you're the CEO going, can we spend more time talking about this? Because, they're thinking you're still trying to win, right? So
I really think it depends on the particular facts and circumstances, the dynamics of what's going on with the board and where the company is. I see, a lot of variation. We certainly have a lot of clients whose boards are looking to try to push this to the very last minute. And it does impact the incentive value and whether management really is going to, trust the board and really work hard for successful acquisition. If there's, no trust there and there's nothing in writing, then, you're really impacting the incentive value of the program. The value of the program is not just to pay out the CEOs or the executives at the time of the transaction. It's really to provide incentive to management to stay with the company through the transaction and to maximize the value of the deal. Ammar, we're seeing a lot of companies, and it's very common in these programs, to add a provision which says that if an executive who's a participant in the plan is terminated without cause within a certain period of time prior to the transaction, that they will be allowed to participate. And that goes to this, this incentive and value